At this point, this could still go one of two ways. One, inflation goes out of control and everything crashes as a result and it's gonna be really ugly. Or two, any inflation we see is temporary just due to post-pandemic transitioning and everything is gonna be just fine. The way I see it, here's what's likely gonna happen. Last week was very rough for the stock market. That's because on Wednesday, May 12th, a new piece of data came out showing that US consumer prices had risen 4.2% over the last 12 months. The market freaked out because we have not seen a big jump like this in CPI in 13 years. 4.2% is a pretty big jump for the CPI. And if we keep getting data like this, it could be a sign that inflation is getting out of control. Another sign that more and more investors are getting worried about inflation is the rise in prices of investments that serve as inflation hedges, such as commodities. According to this chart, commodity prices have jumped sharply this past year as well. Could be another sign of inflation. Also, the break-even rate, which is the difference between regular bonds and inflation-protected bonds, has been ticking upwards as well. The break-even rate is a measure of how much inflation the market is anticipating. So clearly, inflation is becoming more and more of a concern as indicated by several different measures. Since inflation happens when there's too much demand and not enough supply, one way the central bank deals with that is by raising interest rates. Raising interest rates is a quick way to stop inflation in its tracks because higher rates makes it more expensive to borrow money to go out and buy things, which means there will be less demand. So high inflation usually is followed by higher interest rates to control it. So last week's alarmingly high inflation data, and therefore the prospect of high interest rates, came as a shock to investors because the stock market doesn't like high interest rates. It likes low interest rates. The lower the better, because low interest rates makes investing in stocks the most attractive option from a yield perspective. So low rates equals high stock valuations equals happy investors. Over the past decade or so, stock investors have been very spoiled by ultra low rates and lots of money printing. With so much cheap, easy money chasing a finite number of stocks, stock prices have majorly benefited. But just like a crack addict whose body has become so dependent on the high of that drug and would experience extreme pain if that drug was withdrawn, any sign of inflation and therefore withdrawal of easy monetary policy is going to be just as painful for the stock market. Hence all the stock market jitters last week. Still, let's keep things in perspective, yeah? The recent CPI number of 4.2% is high, but it's just one data point. The general sentiment now is that this alarmingly high inflation number is probably just a one-off thing, and due to the crazy nature of what the world just went through with the pandemic, that we really shouldn't extrapolate recent data all the way into the future. At this point, this could still go one of two ways. One, inflation goes out of control and everything crashes as a result and it's gonna be really ugly. Or two, any inflation we see is temporary just due to post-pandemic transitioning and everything is gonna be just fine. The way I see it, here's what's likely gonna happen. The next inflation data release date is June 10th. Now the pandemic messed everything up so much that my guess is that the next few data releases, including this one on June 10th, are going to hint at higher inflation and cause some volatility in the market. There's a lot of pent-up demand right now. We've all been stuck at home, and at the same time, supply chains have shut down. There's a lot of shortages. Things have just been weird because of the shutdown. Not to mention the trillions of dollars of stimulus that Biden just signed into law. All this is very inflationary. Hence, high-ish inflation is to be expected as things open back up and all that stimulus money works its way through the economy. And since the market loves to overreact to everything, stock prices are gonna fall every time there's any sort of data or hint of higher inflation. My guess is the rest of this year is gonna be a very bumpy ride as the market tries to figure out where inflation is going to go and where interest rates are going to go. The stock market has been artificially propped up on low interest rates and on huge amounts of stimulus for so long that stock prices are very sensitive to even the slightest possibility that the Fed might stop with its easy monetary policies. Remember that analogy of the crack addict and how painful it is when a drug you've gotten used to suddenly gets taken away from you. However, I do find it hard to imagine inflation taking hold long term and becoming like a really huge problem long term, like it did in the 1970s when inflation went into the double digits. I really find that hard to believe will happen, because even though there's a lot of inflationary factors at play right now, the trillions of monetary and fiscal stimulus, low interest rates, so on and so forth, there's also huge amounts of deflationary forces at play as well. And I don't think these things are talked about enough. The biggest deflationary force counteracting inflation right now is tech innovation. Something that's brand new for the 21st century that we've never had before is the ability for unlimited scaling and efficiency due to technology. Thanks to computers, robots, we can now produce more than ever using fewer labor and resources than ever. That is the total opposite of inflation. So tech innovation eats inflation. And don't even get me started on AI and self-driving cars. There is so much coming on the horizon that is deflationary, it's gonna be exponential. And so yes, we have exponential money printing and exponential inflationary factors going on, but we also have exponentially deflationary things going on as well. So even if inflation does pose a threat in the short term, I don't think it's a reason to panic and abandon your long-term investment strategy, because I really think deflation and inflation are sort of counterbalancing each other. If anything, temporary inflation will cause some hiccups in the stock market and present a good opportunity for you to buy more stocks. And if you own any stocks right now, I hope you have strong conviction on them, because I do think it's gonna be a bumpy ride. A good test of your conviction is, are you willing to buy more of those stocks after a crash, or are you gonna wanna bail? If you think you'd wanna bail, it's probably best to just bail right now while prices are relatively still high. I feel like that's why tech stocks fell so much last week, because compared to the S&P 500, which is not as much tech stocks, compared to, say, the NASDAQ fell a lot more. A lot of stocks of tech companies that aren't consistently profitable yet, Tesla, were already so overvalued that any weak hands got forced out at the first sign of higher interest rates. So I think that's just gonna continue. Also, when it comes to protecting your portfolio against inflation, I wanna point out the difference between short-term thinking versus long-term thinking. In the short term, inflation hurts stocks because of all the things we talked about. Inflation means higher interest rates, which makes stocks less attractive and thus makes stock prices go down. When inflation hits, the best short-term way to protect yourself is to invest in commodities or inflation-linked bonds, which actually go up in value along with inflation. But in the long term, commodities or inflation-linked bonds will just break even with inflation. So there's a difference in how they respond in the short term versus the long term. To actually beat inflation over a 10-year period or more, you need to be in stocks. In fact, according to this Vanguard study, stocks are the only investment that return anything over and above inflation. Other than maybe Dogecoin. Kidding. Just wanted to see if you're paying attention. Outside of stocks, all the other asset classes just kind of break even. Meaning if you invest only in bonds, commodities, or cash, you would have made a 0% return after factoring for inflation over the long run. So stocks, 6.75% return after factoring in inflation, and everything else, 0%. Moral of the story, stay invested. And if you're already invested, plan on investing even more if the stock market drops again because of inflation data. Think long term. Keep in mind that news headlines are going to talk it up and make inflation sound like a threat to your very existence, because that's what gets clicks. But don't forget that the only proven way to stay ahead of inflation in the long run, which is the time horizon that really matters for us, the only way to beat that is to be invested in stocks. Okay? That is it for today's video. Hope you found it helpful. Thank you so much for watching. Know that I really appreciate you, because I know there are a million other things you could be watching instead. Don't forget to subscribe if you're new around here, because I post new videos every Wednesday, and I'll see you next week, same time, same place. Bye!